All right, here we go. Our read is unchanged, exactly as expected on headline. Flip it down to core. X, of course, the important food and energy. Also, spot on with expectations, up 0.2, up 2.2 on year over year, exactly as expected. And X food and energy year over year, 2.2. These numbers are exactly as the market and analysts had predicted. But if you do look sequentially, there's a couple of interesting things, of course, like yesterday's PPI. This month is much tamer than last month, which was up 0.3 and up 0.2, respectively. But maybe most important was that year-over-year number. Last look, it was 2.5. Now it's 2.2. Keep in mind that 4 months ago it was 2.9 back-to-back. And that was the highest read going back to December of 2011, last time we saw 3%. So inflation certainly seems to have peaked for this cycle, and several months ago, actually, now if we put all the pieces together. So it's going to just make more interesting fodder for the FOMC committee next week, especially when you consider all the global issues that are at stake at this point in time. Becky, back to you.
Stick around, Rick. Yeah.
All right, Rick, thank you. We're going to continue this conversation. Steve Liesman is here, too. Steve, what do you think?
Well, just a couple quick things. Gasoline down by 4.2%. That's obviously not a core part of the core calculation. I think that comes off at some point. So I feel like the Fed is going to look through that downdraft there. Other stuff is kind of all over the place. You have this rebound effect to the still existing in used car prices after the storms. You get this, you're shaking, you know what I'm talking about, Mike, right?
People are buying cars cheaper because they were flooded out?
Cars get flooded out, they buy cars, used car prices surge, and they're still up a bit because new car prices are up 0, and the new and used are up 0.8. I don't have the used number here, but it's here. Medical care has been an interesting number. The year over year has been quite muted, and I'm not quite sure why, but 2% year over year, that's a number that usually runs 3 or 4%. I think the Fed's going to see this as sort of in line, not trying to micromanage, tensor, and I know that might get Rick angry. But, Rick, I have a chart here. I don't know if you can see it. You got a monitor there. And it asks the question, what's normal? And what you'll see is you'll see the CPI core year-over-year percent change, and you'll see the Fed funds rate. And what you'll see, I'm describing this chart because I have great hopes it'll come up one of these moments, maybe not, is that the CPI runs above the Fed funds runs above the CPI until the Great Recession. And then it was below it. And as the top of the chart, I'm sorry about that. Right now, the Fed is trying to reach up to the point where it's at least equal to, or a little bit of trying to get to a positive or at least neutral Fed funds rate. Rick, is that a worthy goal, an unworthy goal? What is your thinking about what is the normal for the Fed funds relative to inflation, my friend?
I don't think there's any good litmus test that I could describe in any short period of time as to what would be a good definition of neutral. But I would say this, that the best way a market participant over the decades has looked at a neutral rate and maybe not described it in that vernacular is at the point where policy becomes an issue, a fundamental for the markets that seems to affect either the complexion of the yield curve or the investment tone towards the interest rate and fixed income sector. And I think that's as good a way as I can put it. It's a monumentally difficult task, but I think that this particular episode is most difficult because of the artificial areas from which the Fed has to rescue rates and compound that with the notion that they most likely, history will prove, waited much too long after the crisis to try to go down the road of normalization.
Rick, if you give me money today and I promise to give it back to you tomorrow, should that be a free transaction for you?
Well, nothing is free. No, there would have to be a 24-hour amount of VIT.
It is now. There's no compensation
it should be free for him
on an inflation-adjusted basis.
You're talking about him giving you money. You mean, should it be free for you?
Right. There's no compensation on an inflation-adjusted basis for that transaction on an overnight basis.
You used to pay someone just to keep their money for a, remember? I mean, there was a time where you got back less than what I gave you, and I was happy to get it just because you held it for me. At least we're beyond that. That was your idea.
I guess at the bottom of this, Steve, I'll ask the most fundamental question of all.
As you often do.
Why is it that the Fed believes reducing the purchasing power of every American a little bit a year is the right thing? And how in God's earth could they calibrate it at the same level, for example, of Europe at 2%? None of that makes any sense.
So you want to go to a zero inflation goal?
No. I want to do exactly what the pillar says, stable prices. And trust me, we've had stable prices for a long time.
What are stable prices, though, on an inflation basis, Rick? What number would you put that at?
Anything less than it was up till about 1988. How's that?
So now it's 2. Do you call it stable now?
I would say that stable has to be a function of a equation that includes productivity and growth. So if you have a 3% economy or a 4% economy, your inflation rate should be some subset of that, less than that. But when you have a 2% economy, as we did for 6 years, thinking you're going to have a 2% inflation rate as your target and you're going to use that hammer to try getting those outcomes, to me is insane.
Rick, let me ask you one other question. I was thinking earlier when Steve pointed out what we've seen in gasoline and how that doesn't really apply into the core. Do you remember probably 11, 12 years ago, we used to get into these long discussions about core and whether they should be paying attention to core or not, because of course you have to eat and you have to pay for fueling up your cars along the way. I mean, it's such a weird factor right now because oil prices have dropped so dramatically. How do you kind of put any of that into the equation, especially if you're trying to determine what the economy's doing right now?
Well, a lot of what goes on in commodities, that volatility, especially in energy, is really difficult with respect to the lasting effects. So I can't give you an easy answer there either. Yeah. But I do think that I would like to look at everything together, and in a more important aspect, even volatility aside with respect to energy. I don't understand the notion that we try to make everything so static. If energy's moving up and down a bit, I don't think it's outside the realm of expectations for the opinion of the Fed not to be crazy volatile, but to think that they could have some symmetry and shadow that should they believe that that type of movement warrants some type of backstop with respect to the overnight rate. I think this notion that they have to advertise what they're going to do and hardly change it at all from a pre-described course is not good for policy. And I also think what little that they do on interest rates can have outlasting damage, but what they really try to accomplish is still like watering a geranium from 3 miles away from with a fire hose. You know, what they aim at, they so little effect, and the outside effects of their policy are much larger than what they're concentrating it on, and that is a problem.